section of our conference, prospects and opportunities of CBDCs, and we have on stage our moderator, Mihnea Konstantinescu from National Bank of Ukraine. Mihnea is head of research at the NBU. His experience includes a diverse range of professional roles in managerial and executive positions at various seniority levels in finance, real estate, and central banking. And we have our participants. It's absolutely international panel discussion. It's amazing. Scott Henry, Bank of Canada. Alexei Grimm, Bank of Finland. Aiste Jushkaite, Bank of Lithuania. Yuko Kawai, Bank of Japan. And Haro Boven, the Nederlandse Bank. So, Mihnea, it's your stage and your guests.
Thank you very much.
Thank you.
Are we on? Okay. I'd like to thank the organizers for inviting me to be here today. I hope you find our discussion interesting. It's an excellent topic and something near and dear to my heart we've been working on for a few years. At some point there's going to be some slides that show up. I wanted to keep this fairly brief to talk for a couple of minutes about some of the potential benefits of central bank digital currency. You'll hear a lot of different versions of this today. You've already heard a couple of versions, and I just wanted to focus on some of the things that I personally think are the potential benefits of central bank digital currency. And the one thing I should say is that these are my own opinions and not necessarily those of the Bank of Canada. You'll hear that a few times up here. So there's a few things up here, or a few things that aren't up here that you've heard already, and I'll get to that in a second. But some of the potential benefits I see in central bank digital currency are in terms of offering a competitive alternative to what the private sector offers. Right now we have cash that people have as an outside option compared to private sector payment mechanisms, and I think it is important that something like that continue in the future, where the people do have an option where that if for whatever reason they decide they don't want to use private sector payment options, then they do have something that they can use, whether it be cash or central bank digital currency. And here I'll emphasize that I'm talking about a retail central bank digital currency, not wholesale, so that's something that is open to everyone. And you could view the central bank digital currency as just the next step in the evolution of the efficiency and security of what we already offer in terms of cash. We've gone with increasingly more secure features on our banknotes, and a central bank digital currency could be just the next evolution in currency. It could enhance the resilience of the payment system, again, by giving you an option that's not what's offered through private sector rails. It's something potentially completely different. And for a country like Canada that has very remote regions that are very expensive to serve, it can be seen as a public policy objective to make sure that everybody in the country does have access. And this could potentially mean offline services. So a central bank digital currency can be online, or you can actually design it to have a certain amount of offline functionality, the same as cash already has, so that in an emergency, it can be a resilient alternative to what other electronic systems are available. And the one thing really that the central bank and how it's different from the private sector is in terms of safety. It has the backing of the government, and it is truly a risk-free asset or risk-free payment instrument that is available to the public. And I think this is important, and I think it's important that this is maintained in the future as we go more and more towards an electronic payment system, so that it's not just cash that we have as a risk-free payment instrument, that potentially you need something that's in the electronic space as well. And the private sector payment mechanisms are very secure, but there is a difference between what the private sector is offering and what the central bank can offer. And again, the central bank is truly the only institution that can guarantee universal access. Sure, the private sector wants everybody as their customer, but it's actually everybody who can make them a profit. For us, it's a public policy goal. We want everybody to be able to have access to good payment instruments. Using cash is just the first step of financial inclusion. Otherwise, people are using barter. So we want them to use cash. We'd like them to use something even potentially in the digital space as well. And similarly, we could potentially offer a different form of payments privacy than the private sector can offer. Some people want to be private from the government, some people want to be private from Facebook. It's just a different selection or a different type of privacy than what the private sector can offer. And finally, monetary sovereignty. So what does this mean? The central bank only has power to do monetary policy and financial stability policy if the citizens are actually using the domestic currency. The National Bank of Ukraine can only do monetary policy if the people are using the hryvnia. If people start using something else, whether it's Bitcoin or Libra or the euro, then the central bank loses its power. And it's important to make sure that that power continues because monetary policy is an important tool for macro stabilization. So in the face of some of the threats that are out there, whether it's from foreign central banks or from Libra or some alternative, it can be important to maintain a central bank presence in the market, whether that be in physical or the digital space. So the one thing that you don't see up here is monetary policy. I don't think central bank digital currency in this form, a retail form, is important for monetary policy. I don't think it would really help for negative interest rates. There's many ways of getting around negative interest rates, and I think it would be too hard to enforce it. So I don't think that is really a viable policy instrument, and we don't really need it right now. Monetary policy is already quite effective with the mechanisms we have, so I don't think we need this instrument. But these are some other motivations that have a very public policy underlying to them, and I think it's important that we seriously consider these going forward to make sure that the payments market is supported in a fundamental fashion. Thank you very much.
Thank you, Scott. Alex, your thoughts?
Microphone as well. So first of all, thank you for inviting me to this event. It's a pleasure to be here. Let's see if we can get any slides. So I wanted to use this opportunity to announce the launch of the world's first CBDC. So this is not Sweden, this is not China, this is not the Bahamas. This is actually Finland. So Bank of Finland has launched the world's first CBDC. It is token-based, so it's tokenized monetary value that can be used anonymously. It's intended for retail use, and anyone can use it. It's available to anyone. It's accepted at 20,000 merchant locations, different types. It's optimized for small value payments, and I'll come back to that a little bit later, what that means. And of course, it can also be used online because it's digital. The issuance is done through a subsidiary of the Bank of Finland. So it's a 100% owned subsidiary, a business entity owned by the Bank of Finland. So by now you might be wondering, what is this man talking about? Has he gone crazy? So what's the catch here? What's the catch? Maybe this is just an experiment. No, it's not an experiment. This is a live production system. It works throughout the country. And what gives me the confidence to say that this is the first? Well, the catch is this. We launched this in 1993. And it looked like this. So this was actually a prepaid card. And I did actually manage to find one, so I have one with me. And this one expired in 1997. So we actually did launch the world's first CBDC in the 90s. So this was a prepaid smart card. The value was capped to the equivalent of 500 euros, so this was intended for small values. You could operate it at ATMs and certain merchant locations. It was initially designed for use in phone booths, parking meters. Of course, aren't any phone booths anymore, but kiosks and small retail establishments. And it worked quite well until debit cards came along. So initially, debit cards had a minimum purchase limit, and so this was designed to be used below that limit. And even though it was able to, you were able to do also online payments, of course, there weren't many e-commerce sites in 1993 where you could use this. But one place where you could use this, for example, was the National Library. This was designed to be closed loop in the sense that peer-to-peer payments, offline capability, was actually designed into the system, but it was disabled. So we wanted to, for security reasons, make sure that you could only pay with the card to a merchant. The merchant can only redeem the money back from the central bank or from the entity that ran this. So you couldn't actually make peer-to-peer payments, although that was technically a possibility. So at its peak, we had 1 million cards in circulation, which is about 20% of the population. So that's quite a lot. And it was live in production, as I mentioned. The company was then sold to a consortium of commercial banks. The chip was embedded into their other cards, so you might have a card with debit, credit, and then avant, basically cash. And when the debit card limit was removed, debit cards took over, and the thing basically died, and the plug was pulled in 2006. So we only recently realized that this ticks practically all of the boxes of CBDC. It was issued by the central bank. It was tokenized. It was used in small value payments, online and so on. It's digital. So we're currently in the process of digging our archives and finding a little bit more information because we think that all of us could probably learn from this project. It probably was unknown to many of you, and definitely many in Finland have forgotten about this whole product. But I just wanted to share this with you. Maybe it will be helpful in the discussion. Thank you.
Thank you very much. All right. Well, I'll first introduce myself. My name is Harro Bove. I see myself as a part-time economist and a part-time computer geek. And I'm really happy that at the Dutch Central Bank, I get to merge those two into a full-time job. So, so the title of my presentation is Central Bank Digital Currency in the Euro Area. Now that we're talking about my employer, by the way, I think Scott already mentioned it. So the views expressed in this presentation are my own and do not necessarily reflect that of my employer or of the Euro system. So that being said, this is the content. So what is CBDC? Why is it relevant now? What are some possible objectives of CBDC? And then I'm going to share with you some key lessons learned on the topic of distributed ledger technology, so blockchain, because I think, the topic of CBDC and the topic of blockchain DLT are very closely interrelated, but the actual connection between the two is often unclear. So I'd like to share some thoughts on that, and then some conclusions and next steps. All right, so what is CBDC? So CBDC is a relatively new topic, and as with many new topics, it could benefit from clear definitions. So for me, I think this Venn diagram, I know we've seen quite a few Venn diagrams already, but I'm gonna give you another one, sums it up really well. So this sort of CBDC would be general purpose or retail CBDC, and it's conform 3 criteria. So it's central bank issued, central bank, it's electronic, digital currency, and in the case of general purpose or retail CBDC, it's universally accessible. So here you also see the bordering types of money for CBDC. So you got cash, which is not digital, you got reserves, which are not universally accessible, and you got bank account money, which are not central bank issued. All right, so why now? So why are we interested in CBDC now? I see 2 main reasons, at least for us it's 2 main reasons. First, the access to central bank money. So here you see a chart with the usage of cash in the euro area. And what you see is, what you see is that the Netherlands has the lowest usage of cash in the euro area. It's actually been declining steadily with about 4 percentage points a year for the past decade. So that's the first reason, access to central bank money. The second, and like it was already touched on just now, the application of new technology. So, so what's happening here? So I think as Ms. Kawai shown really clearly is that Libra was a wake-up call for us, and in a sense, central banks have been challenged to come up, to innovate, etc. Because otherwise, maybe we'll lose our primate currency issuance. So there's distributed ledger technology, and there are significant risks of crypto/stablecoins. So the question which this raises is which new technology may be useful and mature enough to use for a public digital currency. Okay, so possible objectives of CBDC. Well, Scott already touched on many of them, so I'm going to skip over this slide quickly. For us, three main topics: access to central bank money, diversity and innovation in the payments market, and the backup function for payments in commercial bank money. So DLT, 2 lessons learned, because DLT is a complicated topic, and we found out that it leads to a lot of misunderstanding. So the first key lesson learned is that the use of DLT does not necessarily give digital currencies the same properties that are similar to physical cash. So DLT stands for distributed ledger technology, and this ledger here is very important because, in a sense, this ledger is an overview of accounts and balances. So, and these accounts, they can be anonymous, they can be pseudonymous, etc., etc. But in essence, there is an overview of what IT people call the global state, which is the transaction history and who owns what at which point. So for cash, this entire transaction history, this overview of the global state, does not exist at a single point in time. Like cash, in that sense, is peer-to-peer, in the sense that I can give a banknote to Ms. Kawai, and nobody except me and Ms. Kawai knows that the banknote has been transferred. This is not the case for if I transfer a Bitcoin to Ms. Kawai. If I do that, somewhere in the global state, so in all the ledgers, it says that that Bitcoin has gone from me to Ms. Kawai, and then maybe it will not say from me to Ms. Kawai, but maybe from my address to her address. And I think that is a key difference. So digital currencies are pseudonymous by default, which means that you see a pseudonym for every account held in the system. Well, with a lot of KYC and that kind of stuff that banks are doing, you can make the system identified, so you know who's behind every account. But in essence, there is an overview of the global state. The entire transaction history exists, and that is not the case with cash. Then the second is that programmable money, also called smart contracts, are not dependent on a DLT infrastructure. So, for example, with the inventors of programmable money, Ethereum, and with Libra, which we've talked about extensively, the two go together. So there's programmable money, which is in essence entails conditional payments, and a DLT infrastructure. But this does not necessarily have to be the case. You can have programmable money without a DLT infrastructure. And actually, for central bank digital currency, that seems like a very worthwhile option to explore, because the essence of a DLT infrastructure is the essential use case of DLT, or one essential use case of DLT, is the fact that no single party has to be trusted enough to maintain the global ledger. But in the case of central bank money, don't we just trust the central bank enough to maintain the global ledger and maintain the integrity of the global ledger? Isn't trust in central bank what makes, well, central bank money so valuable? So those are those are the two key lessons we learned with respect to DLT. Yeah, and then some conclusions and next steps. So national central banks cannot issue a CBDC in the euro area. So in that sense, we're participating in Frankfurt and in the European debate. It's not a panacea. There are complex opportunities, risks, and trade-offs. And we will publish a study covering the objectives, key conditions, and key design issues shortly. So in English and in Dutch. So please stay updated. Thank you.
Many thanks. I will try to give an overview of the topics that we've covered briefly in the presentation and to set up the panel for discussion. All right, so there's four main issues that we look at. The technology, what happens to banks, why do we decentralize, and what do we do about exchange. They've all been touched upon very briefly by the previous discussants. Is it a tech question? Our goal remains financial and price stability, so should we reconsider the functional split of clearing and settling responsibilities? Some people discuss still about CBDC in a two-tier system where we have central bank and commercial banks, so we issue the CBDC to commercial banks. Some people talk about a unique tier, so it's central bank for all. Speed, cost, throughput, security, anonymity, they're all important aspects, but we might say that cost and cost and speed have been somewhat left aside. So would we talk about cost and speed of cross-border transactions had it not been for Bitcoin and Libra? Many people consider banks, central banks, to be rather conservatives in terms of innovation. That's not the case, and our colleagues in Finland have shown this throughout time. So these are two important publications that come from the Bank of Finland, one in 2000. Why in 2000? We already know about e-money, who was supposed to take over the world. It didn't. Colleagues in Finland were already discussing there what are the implications and how do we re-engineer payment system for an e-world. Read how do we re-engineer the payment system for a CBDC world. And more importantly, in 2008, there's an interesting paper on e-settlement, Soon a Reality, in which the author talks about peer-to-peer decentralized clearing. So this paper comes more or less at the same time that the Bitcoin paper comes. Those of us who know about academic publishing, it means the paper was available already in 2006. So it's not just a matter of technology. What are the possible innovation areas in the business models of commercial banks? So if we presume that digital assets, privately issued digital assets, become used more broadly, will commercial banks rely on public blockchains for digital asset management? At what margins? What will they charge? Will they integrate the delivery of Bitcoin against payment in fiat in their existing IT architecture? Do we end up with a Byzantine mashup of ISO standards and blockchain standards? What is the regulation supposed to do? We talk about decentralization. We've seen it in our e-Hrivna project. We decentralize across financial lines, but the important thing to see here is that we can decentralize across economic lines. There are two interesting projects, the Bristol Pound and the People's Bank of Govan Hill. These are experiments in decentralized economic models with priorities given to social inclusiveness and ecologically balanced production. Imagine you are part of this community, you would like to set up a business that follows these principles, you go to the bank and you say, you know, I want social inclusiveness as one of my main characteristics of the business. And the bank says, well, what are your profitability margins? You do not get credit. So most of the time in a typical setting, these models would not secure credit from a traditional bank. So decentralized finance and payments in these two cases emerged simply because they were the result of different economic models. Inclusive money is good. Inclusive credit would be even better. but we should not avoid the discussion on profitability. And this was a talk about what is the business model of e-hryvnia. For example, the Bristol pound now needs financing in order to maintain its decentralized operation. Digital exchange, we've come to talk about smart contracts. They're neither smart nor contracts. Their definition is disputed. We could call them autonomous clearing scripts, because what we actually need is for an exchange to happen without human intervention. So that is a script, it's a piece of software. Now, it can occur faster, lower cost with fewer intermediaries, but what type of money should this script process? Should it be a stable coin? So I took the time to dig in through the literature, because everybody said, well, you know, Hayek said stable coins are the next thing, and you read through and you find out that Hayek himself says, well, strictly speaking, there is no such thing as a perfectly stable value of money. What does he say about Libra? Well, not exactly about Libra, but about those initiatives. As soon as it is possible to say that money is issued by rich financial institutions, the complaint about their abuse of alleged monopoly will become incessant. So maybe we need a global settlement asset, especially if we believe we end up with autonomous clearing scripts. Perhaps SDR 2.0, maybe a fancy app for that. So these are the four major topics that we would like to pick on. We will discuss among, and I hope we will also have time to pick some questions from the public. So the first one is related to the speed of responsibility, the split of responsibilities. Some of us have been talking about the two-tier system. Some have been talking about central bank for all. How shall we approach this question?
Yeah, the one thing I want to say about this is there's many things that need to be sorted out about the business model and how a central bank would come to market with a central bank digital currency, but I don't see any need or motivation to disrupt the banking sector. I don't want to put it out of business. I'm not a Chicago economist who wants to get rid of all the banks and make only narrow banks. I don't think that would be beneficial for the economy at all. I don't think we need it for financial stability. I think we're getting a lot of very good services for the public out of the banks. So I don't think we need to replace that with central banking directly to private sector. That doesn't mean that in some very narrow way there could be services offered, but I think if that is done, it would have to be very tightly controlled to make sure you're not putting out of business everything that's offered by the private sector.
So first of all, good morning to all. Thank you for the opportunity to be here. And I would actually agree broadly. I think it's important. We have now a financial system that has learned from a lot of lessons of crisis and adapted accordingly. So I think it's important not to forget these lessons and not to rush into new systems, just leaving the lessons behind. And I think the same is true even when talking about stable coins. They seem to offer new ideas, but they haven't really gone through an actual really strong shock. So these lessons that we have in form of regulation probably should also be applied in that context, I think.
Okay, I think we'd better bring the questions back on the screen. With regard to the first point, I think let me raise another aspect of my consideration, which is data. If the central bank gets direct access to the individuals or the individual corporations, the central banks will hold numerous data about those users. And presumably, I don't think we're going to use it. But the usage of the data will create some economic value, which will support to some extent, the developments of the economy. So if central banks seizure all those data and monopolize it, and if we don't use it, we're going to sacrifice the development which could be obtained from the data analysis.
When I look at that question, should we redesign clearing and settling of payments? As a researcher, that is an interesting question. You could look at the system as a whole and you'll see if it can be redesigned. But if you think about the practical job of a central bank, it's not really to clear retail payments. That's really the job of someone else. And what the central bank does is settle wholesale payments, and that's it. So I think I'm a little bit careful about, even though as a research question it might be interesting to look at something more holistic, but then we need to go back to see what the central bank's mandate and what its job is in that system.
Yeah, I agree with the previous speakers. I think, and the relation with CBDC is a very interesting one because, well, of course, a lot of clearing and settling is already done in central bank digital currency, but the wholesale version. So I think there are really two dimensions to think in here when we're considering the CBDC debate. So the first one is access. So who should have access to that central bank money? And we touched upon that, discussing the difference between wholesale and retail or general purpose CBDC. But it could, of course, go not as far as general purpose as was suggested on stage before here. Like, there could be fintechs that could get access to central bank money, et cetera, et cetera. And on the other hand, we're really talking about a technical update of the infrastructure. So to what extent should conditional payments be possible? So I won't call them smart contracts, but conditional payments would be possible. So I really think we need to think along the lines of those two dimensions. So who gets access, and what can the clearing and settlement infrastructure do?
Sorry, I just wanted to dispute a couple of points that were made there. I don't think it is necessarily that the central bank's job not to clear retail payments. We already do it with cash. And we haven't had the full public debate to decide not to do that in the electronic space. And I think we need to have that debate before we accept that we're just pushed out of the market by the private sector. 100 years ago, we were doing everything, and we're not anymore. Is that the way we want to go? Do we accept that that is the socially optimal outcome? And I don't think that we've made that analysis to be able to accept that. I'm open to whatever comes about, but I think we need to be having the debate and asking those fundamental questions. And about the data point, the one thing about central bank digital currency, it's very much a balancing act. And it could go very wrong, but it could go very right. We just have to make sure it's done right. And yes, I agree with the points that the central bank would not monetize the data the same way the private sector does. But in many cases, that's a good thing. Right now, the private sector is monetizing our data without our permission. It's getting better in Europe. It's very different in Canada and many other countries where the private sector is taking our data without even telling us and then doing all sorts of valuable things with it. And that should be my choice. If I want to keep Facebook from using my data and making money off it without my permission. So it is a balancing act. Sometimes you want the private sector to have that ability, and sometimes you won't.
That's good. So shall we extend the mandate to
Yeah,
data analysis?
Yeah. I think we basically agree. That's what I meant with the research part. So we want to research the system holistically, definitely. Currently, there's a certain division of labor in the payments, and central banks have a certain role. We need to just be very careful if we justify changing that role and changing that division of labor.
Our roles have been pretty much conditioned by technology, right? We've evolved until now, and the institutions that have evolved were very much conditioned by what we could do or what was available at that time. That's why, for example, speed and cost of cross-border transactions came out to be a flashing point with alternative currencies, because they could offer something much faster and much cheaper, but obviously without the security and the predictability of finality of that, because there's no institution around it. So if the payment doesn't go through, there's nobody you can complain. You can complain on Twitter, right? But there's not much more you can do. Shall we move to number 2? So financial inclusion, we tend to think about this topic in terms of people having the ability to transfer funds. Shall we think about having the funds in the first place? How do we design the system to allow more economically meaningful exchange to happen?
I think this is a very worthy goal, but I think some of the points were brought up before, that it's not at all clear yet that a CBDC can solve the problems. In some countries, the Eastern Caribbean, they're looking at doing a pilot with central bank digital currency because they do have a financial inclusion problem. But there's already ample evidence that the private sector is not serving the public, that the banks are actually pulling back from offering services as opposed to expanding for cost reasons. So from a public policy goal, there's a void, and the government can step in and fill that void. In other countries, that doesn't happen or isn't happening. So you really have to understand why there's a financial inclusion problem and then figure out what's the best solution. Do you force the private sector to do it? Generally, it's not good to force people to do things. Or you can step in and do it yourself. So it'll be a case-by-case basis.
I would also agree with the different aspects of financial inclusion. So the way you phrased it, what do we do about having the funds in the first place? I'm not sure that CBDC would be able to solve that. Yes, CBDC probably could be helpful in, as you say, where the bank's business model doesn't allow, or the banks just choose to close down the bank branches, close down the ATMs. Yes, in that aspect, it could help. At the same time, if we talk about, let's say, inclusion of different groups, age groups, or in any this is maybe where we can think whether central bank, if it goes ahead with the CBDC, whether central bank is at the best place to develop a product that is most available to all the groups, or if it's better in a two-tiered system where central bank just provides the rails and then the private sector, provides the products best suited for all.
Yeah, I think it's important to go sort of problem first and not solution first. So if we want to solve financial inclusion, then we should put all the different options on the table on how to solve that, and think about what the central bank can generally do about solving financial inclusion. Could CBDC be part of that? Maybe, but I'm not sure financial inclusion. Yes, it's an important driver in some countries for CBDC projects, but in other countries it's not. So whether it's a question about financial inclusion, I think we need to look at then all the different things on how we can solve financial inclusion.
Are there any questions from the public on the first two topics? No? Then we can perhaps move to number 3. So maybe a global digital asset for settlement of...
Yeah, this is one that I haven't thought as much about. I think global cross-border payments are definitely a pain point. There is some very serious problems there. They're costly, they're slow, they're opaque. There are some very big things that can be changed. I think the major part of our effort these days should be on simply fixing problems in the current system. That there can be linkages between our current RTGS systems that would be a lot easier to do than building up a completely new system of for cross-border payments or coming up with a completely new asset. There could be, there's probably some value. There's arguments that it would be better to have a settlement asset that's not related to any country, so an SDR could be beneficial in that way. But I think there's a lot of open questions there.
I would agree with a lot of open questions, and I'm personally very enthusiastic about the cross-border settlement part of the CBDC discussion. I'm very happy to see that we have, and I think that we need even more joint effort in the CBDC discussion among central banks. And I think I'm not sure if SDR 0.2 is the best version, but why not? But I'm just trying to imagine the world where every single jurisdiction has its own CBDC in its own currency, designed to solve the problems that it has. And the interoperability is not solved. What then? Are we happy? Is the task finished? So I think that's a very important aspect to still consider.
Yeah, I agree, and it's really a next step, but one we should be thinking about already. So, if of course, like inside currency areas, it's important that if a central bank is going to issue a CBDC, it's important that the use case and the objectives are clear. But we should definitely not lose sight of similar standards of opportunities that arise there to also make cross-border payments more efficient. So yeah, definitely important. And I agree, the marketing of SDR 2.0 might not be perfect, but we'll figure a good name out in time.
Yeah, I agree with the parts about SDR. I mean, it's not really a global settlement as it is. It is more like a quota to acquire other reserve assets. But anyway, yeah. So cross-border payments. I think it was mentioned in a few different presentations that where's the line between private sector activity and public sector activity. Yes, cross-border payments are quite expensive and slow still, but they're improving. And you can use different apps to do remittances quite effectively these days, and there's a lot of new companies and fintechs that are developing cross-border payment solutions. And again, I think an important question to ask is, what's the role of a central bank in that whole thing? Whatever the central bank can do within its mandate, sure, let's do it. But probably the majority of that activity will still take place in the private sector.
If I can just briefly note, during my presentation, I gave a note of skepticism about the use of DLT for central bank digital currency. But I think here, in the specific issue of cross-border payment, DLT has very, very interesting potential, maybe more interesting than inside currency areas, because here actually you can imagine that it's going to be hard to find a single trusted party to maintain the ledger of the settlement asset. So let's call it the SDR 2.0 for now. So the SDR 2.0 ledger might very well be maintained by several leading central banks in the world, and and sort of be a permissioned distributed ledger technology option for cross-border payments. So there I see a very interesting use case of DLT.
Yeah, just to pick up on that a little bit, you don't even need the single global currency to do that. You can have a single ledger trading multiple currencies. So we could still have central banks issuing their own currency traded on a single ledger globally.
I would agree with that. It's just one, I don't have a suggestion, just an interesting aspect. Say you have one jurisdiction that says that privacy and anonymity is very important. They want to maintain the privacy of cash transactions, and another jurisdiction says that they want to fight illicit activities, therefore they do fully transparent CBDC version. And then you have the same global ledger that needs to settle between the two CBDCs. I find that could be also another kind of aspect of discussion.
Yeah, I'm not enough of a technologist to figure out whether it would be possible to have an anonymous token and a non-anonymous token circulating on the same ledger. But the thing that worries me more is even if it's 2 ledgers, a digital currency is a global phenomenon. If there is a country that puts out a Bitcoin-like coin, it could be used anywhere. How do you actually control it? And how do you enforce that it is not used by your citizens?
Okay, so you were saying before that banks stopped offering many services or are pressured by costs. If we move to a DLT world, costs for quite similar financial transactions and services are extremely low. We see now banks losing a little bit to the payments. We see banks losing to AI in asset management and so on, maybe portfolio management. Where are banks going to make money? Are they going to work as custodial services for Bitcoin? What is the regulator coming in and doing at that stage?
Personally, I don't think there's really that much to worry about from DLT for banks. I don't believe that it is necessarily a more efficient, less costly way of doing things. It's just a different way of doing them. It depends on what your starting point is and what you're comparing it against. For certain parts, or maybe the end user, it might be cheaper, but it's not clear that it would be cheaper for the operators. The Bitcoin system is certainly extremely expensive to operate for miners. So I think there is lots of roles for the banks to still play, whether it's there is a CBDC or there isn't, or whether there is a DLT or there isn't. There's going to be a lot of evolution, and I think the banks and the private sector in general is going to have a very fundamental role to play and lots of opportunities for innovation and profit.
I perfectly agree with that, because we are now shedding the lights only on the payment side, but there are many other things banks are doing. Like, well, for example, like who's going to make loans? Maturity transformation, credit risk taking is the very major role banking sector is taking, and it's not being replaced by DLT.
I think in the discussion around DLT, what is somewhat amusing is that we've kind of raised it to a board level question when I think it's very much a sort of software architectural question, and I'd rather leave that to software architects to choose the right kind of product or the right kind of whatever technology they wanted to solve a certain business problem. But I think on the management and board level, you should be talking about the business problems, or the policy level, you should be talking about the business problems, and not assume that a certain technology is the solution.
Yeah, and on sort of a humorous note, so of course I shouldn't advocate private solutions here, but there's actually a Google Chrome plugin that every time you see the term blockchain on a web page, replaces that with multiple copies of an Excel spreadsheet. And I think that's actually a very, very nice way to think about DLT. And I completely agree that it's really a software architectural question. So in essence, it's multiple copies of an Excel spreadsheet. So in that sense, it's not a solution. It's not a solution. It's just a way of getting some things done. And some things are more efficient. Other things are less efficient using DLT. And that's basically that. So the multiple copies of an Excel spreadsheet would be, I think, is a very good thing to keep in mind here.
Any questions?
I would like to, my name is Usman Mandeng, I'm with Accenture. I think the last comment on the DLT, I think it's really important to understand what DLT is. It's not simply a copy of Excel spreadsheets. And I think otherwise the whole debate doesn't make any sense, you see. The key of DLT is precisely that independent databases share the same truth. And that is the key innovation. And unless we think in those terms and what it could mean for carrying money, transferring ownership of value, etc., I don't think we are going to make much progress in the debate about how DLT, and that is the only innovation in CBDC, how DLT can change the way money, what money can do, and the added utility and functionality of money.
No, I completely agree. Of course, it's a simplification, but I think it's still good to keep an image in mind. Yes, the truth, the state of the truth, they're synchronized, and that's a very, very important innovation. But the main point I was making is that essentially DLT is a way of managing a database. And in that sense, I fully agree with your previous statement. That's the main point. But and the illustration, of course, is always a simplification.
I'd like to add maybe, sorry, one more quick comment on that question. So if the problem is to get several parties to agree on a set of data, then isn't the obvious solution to put it all in one centralized database, which they all get to see? It's not really distributing the database, it's actually centralizing the database, which is why we have CSDs, which is why we have ACHs, which is why we have central banks and so on. So there's actually a good reason to centralize things, precisely because of that reason.
Yeah, I would agree with that, but also with the first part of what Usman was saying that it really depends on the use case you're talking about for DLT, that sometimes it might work, sometimes it might not. The one thing I would dispute, though, was the link between CBDC and DLT. You do not need DLT to do a central bank digital currency. It is just one way of doing it, and it is not at all necessary.
All right, thank you very much. Thank you to the panelists, and we can move on to the next session. Thank you.
Thank you so much.